Hi there, my name is Scott Bauer, CEO of Prosper Trading Academy, and today we're going to talk about the VIX. What is the VIX? How does it relate to the market and volatility, and what it really means? Knowing these things is very important for you as an option trader. So let's get right into it. What does the VIX really tell us? What does it really measure? We hear about it on TV all the time. It's the fear index, measures volatility, great, but what does it really measure? One thing to keep in mind when talking about volatility in the marketplace is that volatility is a measurement for movement. In life, when people start to get fearful, nervous, what happens? Volatility goes up, right? Your antennas start to go off. So you're always looking for protection. God forbid something happens or just something out of the ordinary even. It's human nature, we all get nervous. So VIX really measures the same thing, but for the market. We typically see the VIX increase when the market is dropping, and pull that back to just human nature. When the market's dropping, for the most part, the majority of people don't want the market to drop. You get fearful. The VIX in volatility goes up when there is nervousness, uncertainty, right? Uncertainty is really the driver of volatility in anything, in any instance. When the VIX was brought to market, the VIX was a measure of market volatility. But what does that really mean, right? What do the numbers to that really mean? So let's go through some of this here. Okay, so what the VIX is, it's a measurement that represents the market expectations for a move in the S&Ps, the SPX, in the next 30 days. Okay? It is a forward-looking indicator, 30-day forward-looking indicator of volatility. The VIX is really only measuring S&P activity. So it's used, or it's calculated by using SPX options, which are the S&P 500 options at the CBOE that are 30 days out. And what it's doing is it's taking not just the at the money prices, but the calculation, the model takes a wide range of strikes. What it does, it weights prices of puts and calls over a range of strike prices in the SPX. So it's not just taking the at the money volatility, though that is pretty much the biggest indicator. So great. It aggregates all of this data, but what does it mean and how can we use it? Other than knowing, again, looking at a chart here and saying, wow, over the last, 12, 18 months, we've seen lower lows, lower highs. But what is normal? What I have on the screen up here now, this is a 2-year chart of VIX. So we can see prior to COVID where the VIX really settled in. Okay, and that was in the low to mid-teens. For the longest time, the VIX traded in the low to mid-teens. And then obviously saw this massive spike up here when the world fell apart. And as we have been getting back to, some sense of normalcy, we've been seeing the VIX trend back to that area of, normalcy. Okay, but here's what the VIX really measures. Okay, again, it represents an expected range, an expected move. Just like how we calculate our expected moves in every setup that we go through, right, to try and determine which strikes to use, the VIX does the same thing. It also is represented by a 68% confidence level, which is mathematically same thing that we always calculate, one standard deviation. Okay, what does that mean? Well, for those of you that ever remember taking maybe an exam in college, or your kids did, when the professor would say, we're going to curve your grade. Okay, the old bell curve. What that meant was all of the data that is inside the curve here, the bell, that represents 68% of all of the outcomes. That's statistically, mathematically, one standard deviation. Okay, that's what the option pricing model that everybody uses, the Black-Scholes pricing model, prices in, is options with a 68% probability in the move. So let's say the VIX is 20, where it is right now. Okay, what does this actually mean? What is this representing to us in terms of how much the market, when I say the market, I'm referring to the S&Ps, are likely to move? Well, remember, the VIX itself is a 1 month, a 30-day forward-looking measurement. So you would think that that is just divided by 12, right? Because there's 12 months in the year. If we wanted to figure out a monthly move, you would think that the VIX would be, if it's 20, that means it's a 20% expected move in a month. But that's not the case. So the expected vol range for a month is calculated by taking the VIX divided by not 12 or monthly, but the square root of 12. That is the math behind how the VIX is calculated. So if we were to do this calculation and take 20, where the VIX is right now, divided by the square root of 12, when the square root of 12 is roughly 3.5. Okay, I'm just going to round it off. So if we take 20 divided by 3.5, get out my calculator here, we get 5.7. That means a VIX of 20 is actually representing that the market is pricing in a move of 5.7% over the next 30 days. Again, this doesn't tell us direction, just like when we figure out the expected move when we're looking at a stock. It doesn't tell us direction. It just guides us to the size of the move. So if we were to compare that to a VIX that is closer to its historic levels, okay, if we were to use the same calculation but use the VIX at 15, okay, we would take 15 divided by that same denominator of roughly 3.5. Remember, square root of 12. And if we do that, that calculation comes out to 4.29, 4.3, I'll round it off. So if the VIX was 15 instead of 20, then the expected move over the next month is 4.3%. And if the VIX was 30 instead of 20, then we would take 30 divided by 3.5. And now what that is representing is a move, an expected move of 8.6% over the next month. So if those are the expected moves based on where the VIX is, then the options need to be adjusted appropriately to represent those moves. Now, let's do that for a week. Rather than a month, let's break it down to a week. Well, if you use the same logic, when we were doing it for a month, 12 months in a year, we took the square root of 12, right? If we do it for a week, we use the square root of 52 as our denominator. So the square root of 52 is roughly 7.2. Okay, so a VIX of 20 divided by 7.2. Okay, if we were looking for a weekly move, that equals about 2.8%. So on and so forth. And we can obviously do the calculations for if the VIX was 15, 30, 50, whatever it is. And if we were looking for the daily move, which I personally think is the most important measurement to look at, we take the square root of 365. And we use 365 because even though there are only about 250-ish actual trading days in the year, 255, something like that. Options don't stop working because of an off day in the market. Options still decay on a daily basis, even on weekends, even on holidays. So we use the square root of 365, which is roughly 19. So a VIX of 20 divided by 19, gives us 1.05. So if the VIX is trading 20, that is representative of the market moving 1% a day. So how do we use that? Well, let's say the market was trading in a 0.5% range daily, but the VIX was 20. Something's out of whack there. Either the market has to start trading more volatilely, or the VIX is too expensive, and vice versa. This is why it's important to understand, guys, the math behind what the VIX really means. Not the actual calculations of what goes into each strike and the long-winded algorithmic math, but the math of what I presented on the screen here. Here is a VIX frequently asked question page that I'm just taking right from the CBOE. If I bring this in here, what I want to show you is what you don't need to know. That's what you don't have to know. That's the nuts and bolts. If you really want, are a math geek, statistician, and you want to get into that. You don't need to know that. Just like you don't need to know how the Black-Scholes option pricing model works. You need to know the inputs and what makes option pricing move, but you don't need to know all the math behind it. But if you ever have time and if you have interest, the CBOE website really will give you an extensive look into what the VIX means, its calculations, other volatility products that are out there. It's actually a very, very excellent place to learn. So that is the VIX. I hope that wasn't too confusing and made sense to you. Knowing how to use the VIX in trading options is crucial to your option trading career. And if you have any questions at all, please leave them in the comments down below. I really hope you guys enjoyed the video. And if you did, please like, comment, and subscribe to the channel for more content. New videos come out every Monday and Thursday. Take care, everyone.